All right, today we're tackling a big one, technical analysis. You know, it's often seen as this kind of art and science of reading the market's mind, but it's also one of the most debated ideas in all of finance. We're going to dive right into the charts, the patterns, and the collective psychology that really drives this whole thing. Okay, let's get into it. I mean, that's the million-dollar question, isn't it? Can you really look at a bunch of squiggly lines on a chart and figure out where the price is going to go next? To a lot of people, it sounds way too simple, maybe a little bit like financial astrology. And you know what? That skepticism is the perfect place for us to start. So to really get what technical analysis is, it actually helps to first understand what it isn't. Think of it like this. On one side, you've got fundamental analysis. This is your business detective, right? They're digging through spreadsheets, crunching numbers, asking, what is this company actually worth? But on the other side, you've got the technical analyst. They're more like a market psychologist. They're not really asking about a company's value. They're asking, what is the market thinking right now? What is it feeling? And they believe all the clues are right there in the price chart. So here's how we're going to break it all down. First, we'll get clear on what it is. Then we'll look at the core beliefs behind it all. After that, we'll open up the toolkit that analysts use. Then we're going to get real about the common mistakes people make. And finally, we'll talk about how to find the right strategy.
Okay, let's kick things off with Section 1 and get a proper definition on the table. What are we actually talking about when we say technical analysis?
At its heart, technical analysis is kind of like being a market weather forecaster. You're not trying to understand the complex physics of the atmosphere. You're just looking at the clouds, the wind direction, the pressure systems to figure out if it's going to rain tomorrow. The core idea here is that all the science, the earnings reports, the big news, the economic data, it's all already baked into the price. So theoretically, all you need to do is learn how to read the chart.
Now, for any of this to work, you kind of have to buy into a few core ideas. This is the philosophy that props up every single chart pattern and indicator.
It really boils down to three main assumptions. First, the market discounts everything. That just means any piece of information that could possibly affect a stock's price is already reflected in that price. Second, price moves in trends. The idea is that an object in motion tends to stay in motion. And third, and this is a big one, history tends to repeat itself. And this is where it gets really interesting. Why does history repeat? Well, it's all about market psychology. See, the technology changes, the companies change, but human nature, that doesn't really change. The emotions of fear, greed, excitement, panic, they're the same today as they were 100 years ago. And it's these powerful, predictable human emotions that create recognizable patterns on the charts over and over again.
Okay, so if you're trying to read these psychological footprints in the market, what tools do you actually use? Let's dive into the analyst's toolkit.
Well, it all starts with the chart itself. A simple line chart, yeah, it gives you the general direction. But a candlestick chart, that tells a whole story. Each one of these little candles is like a snapshot of the battle between buyers and sellers for that time period. A big green candle, that was a clear win for the buyers. A little red one with a long tail, maybe the sellers try to push the price down, but they're losing their grip. It just gives you a much richer view of what's going on.
And once you're looking at those candles, you start to see shapes or patterns. Analysts look for these repeating formations that might signal what the crowd is about to do next. This one here is a classic, the head and shoulders pattern. When traders see this, it's often taken as a big warning sign that a nice uptrend might be running out of gas and could be about to turn around.
Now, on top of the raw price and patterns, analysts add another layer, indicators. You can think of these as special lenses you put on the chart to see things more clearly. A moving average, for example, is super common. It just smooths out all the chaotic day-to-day price noise so you can get a better sense of the actual underlying trend. It helps you see the forest for the trees, so to speak.
And trust me, the toolkit is absolutely massive. There are entire schools of thought here. Some traders are purists. They only look at price action. Others are pattern hunters. A lot of people follow trends with moving averages or use complex mathematical oscillators. The key thing to remember is that they're all just different ways of trying to do the same thing. Interpret human behavior as it's reflected in the market.
So with this huge toolkit of charts and patterns and indicators, you'd think every trader would have a massive advantage, right? You'd think they'd all be making a killing. But the reality is way, way more complicated. So why do so many people who use these tools still end up losing?
Now check out this number. It's pretty staggering. Some experts estimate that as many as 95% of traders who misuse or misunderstand technical analysis ultimately lose money. So it's not just about knowing the tools. It's about understanding the pitfalls, and there are a lot of them. And look, these aren't just technical errors. These are the psychological traps that just absolutely derail traders. Relying on just one indicator is like trying to navigate the ocean with a single star. Ignoring huge news is basically just sticking your head in the sand. And trading based on FOMO, that fear of missing out, that's pure emotion taking over. But the biggest sin of all? Having no risk management, no plan, like a stop loss to get you out when you are inevitably wrong.
And it's not just about individual mistakes. The entire field faces some really serious academic criticism. Some say it's all just a self-fulfilling prophecy. A pattern works only because a million traders see it and all act on it at the same time. Others, who believe in the random walk theory, say price moves are totally random, so looking at the past is pointless. And maybe the strongest critique of all, a pretty chart can't tell you if a company is secretly about to go bankrupt.
So, all of this brings us to the most important part of our discussion. How should we really think about technical analysis? Is it some magic crystal ball for printing money, or is it something else?
I absolutely love this quote from an expert at Blue Sea Capital. Candles create indicators, not the other way around. It's such a powerful reminder that all those fancy, complicated indicators, they're just byproducts of price. They're reactive. They lag. The price itself is what's real. And in the long run, that price is driven by a company's actual, fundamental value.
And that right there, that gets to the heart of it. Using technical analysis successfully isn't about being right 100% of the time. Nobody can do that. It's about playing the probabilities. It's a framework for identifying potential entry and exit points, and, this is the most important part, for managing your risk. It gives you a disciplined plan so you cut your losses and let your winners run based on rules, not on fear or greed.
So we end up right back where we started, but hopefully with a totally new perspective. Maybe the point of reading all these charts isn't really to predict the future with perfect clarity. Maybe it's about understanding the psychology of the market right now and using that understanding to build a smart, disciplined framework for managing the unavoidable risks of investing. What do you think?